Yeah, absolutely. Thank you guys for having us. So just to kind of kick us off, so we're all from UMUM. So my name is Stefan Schlabs, and then we got Newlove, who is in Portland, and then Conor Hale. Tia is a CPA, which if you don't know stands for Certified Public Accountant. And then Conor and I are both CFAs, which stand for Chartered Financial Analysts. And so what we plan to talk today about, if this will go, is personal finance. So just to kind of start us off though, like when you hear finance, you might think a lot of things because there's a lot of different components of finance. But for personal finance, we're talking about things like debt, things like budgeting. So, making sure you have enough money for stuff, things like taxes, and then personal investing. So that's what we'll go through today. But just to differentiate that between personal finance and corporate finance. So corporate finance is more like for a company. So like UMUM, for example, has corporate finance. We also do accounting, and we do things like cash management, where we have to make sure that we have enough cash to pay for things. We do financial analysis, which basically means we look at our numbers and say, why did it move the way that it did? We also have debt at the company, and we also have to do a budget. So it's sort of like a personal finance, but for a company. We call it corporate finance. So that's one. And then there's also investments. Investments is different than personal investments in the fact that you actually have investment companies who are going out and buying investments for clients. In fact, UMUM actually is a giant investor. We invest about $60 billion, which is a big number if you you know anything about numbers. And so, yeah, so that's kind of like the overview. But like I said, today, we're going to talk a little bit about personal finance. So to do that, we're going to start off with credit. And so I'll turn it over to Conor to talk a little bit about that.
Yeah. So like Stefan said, my name is Conor Hale. I work at UMUM in finance with Tia and Stefan. So I'm going to talk a little bit about credit. What is credit? Different types of credit. Not all. And I'm going to use credit and debt interchangeably. So that I apologize, but you can basically use it interchangeably. So I'm going to talk about what is credit, different types of credit, how credit works, what interest is, what principal is, and then go through some specific examples. So do you want to look? So what is credit? So basically credit is, or debt is when a bank or a financial institution gives you money to purchase something with the understanding that you will pay them back over time. So when you think about this picture here, think about those hands that are handing over the money as the bank. Think about the other hands as you, as us. Or as a company, like Stefan said, but we'll focus on the individual aspect right now. So here, the lady is taking $100 from the bank, and over time, she'll pay back that $100. She'll go use that $100 to buy something, and then over time, she'll pay back that $100 to then to settle that debt. So if you want to go to the next slide. So not all debt or credit is created equally. There's good debt, and there's so-called bad debt. So good debt is when you take that money that you borrow from the bank to purchase something that you believe or that is generally believed to accrete in value over time. These types of debts or credits typically have lower interest costs related to them because the banks know that you are going to go out there and purchase an asset that will create value, so there's less risk there from the bank's perspective. Bad debt, it's basically the opposite. It purchases something that will lose value over time. So if you think about a car loan, if you go out and purchase a car, as soon as you drive it off the lot, it usually loses about 20% value. So say you buy a $50,000 car, and you drive it off the lot, or $5,000 car, sorry, 50,000, that's cars, worth 50 grand, but $5,000 you drive it off the lot, it's worth $4,000. So there's more risk to paying that off over time. The banks see that as a higher risk for them. So there's higher interest costs. It costs you more money to get that debt, to get that money. So a few examples. The mortgage is considered a good debt because houses will increase value over time. Real estate is a good investment. Education. So if you get a student loan to go to college, that is you're investing in yourself, and that will create value for you over time. So there's less risk there. As the banks see that they're going to lend you money now, you're going to go to college, spend that money on college, and then you will get a job and earn money and pay that loan back over time. Business ownership is very, very similar to the two above. You know, if you go out and want to start a business, say you want to start a restaurant. Well, a lot of people don't have enough money to just go out and buy a building or lease a building or buy all the food and hire all the people that it's involved to start a restaurant. So you have to go out and take them and loan them or loan money or borrow money from the bank. And so that business over time is thought to accrete value, so that's good debt. Bad debt, car loans, we already talked about how they lose value over time. Credit cards, most of the things we buy with credit cards, food, clothes, you name it, those things lose value over time or are completely disposable over time. And then cash advance and easy pay loans. Those are very, very high interest rate loans. Those are seen as a bad debt because there is a lot of interest there, a lot of interest costs there. So if we want to go to the next one. So here's just an example of how a payback period would work when you're paying back your loan. So if you look at the far left column there, today the bank gives you a loan to purchase a car for $5,000. That nice Ford Focus there. I wish that Ford Focus was worth $5,000. So the bank will give you $5,000, and then you get to take that $5,000 and you go purchase that car. So you have the car. You've given the car company the $5,000, but then over time you have to pay back that loan that you took from the bank. So you see that all those years that it took you to pay back the bank, it adds up to more than the $5,000. So you're like, wait, why am I paying back the bank $6,250 when I only borrowed $5,000? Well, there's a little thing called interest, and that is what it costs you to borrow the money from the bank. Because the bank is taking on risks. There are risks that you won't be able to pay back, different things like that. So you see here in this example, every year you pay $250 of interest. And the other side of that is $1,000 each year that you pay back. It's called principal. So that's the $5,000 that you borrowed, and then you have the $1,250 that you pay back in interest over. So that's just a little example of how a loan payback might work. All right, and then a big one we'll talk about is credit cards. So a credit card is basically a card that the bank issues you. It has a maximum amount you can spend on it, and that is called a credit limit. So you go out and you apply for a credit card in the bank, and they'll give you the credit card with, say, you can only spend $1,000 a month. Well, once you get that $1,000, you know you no longer use that credit card. It's maxing out your credit card. Well, if you don't pay back that credit card over the next month, then you'll owe something called interest, like we talked about with the car loan, and that can be very expensive interest. And it can ding your credit score, which we don't necessarily get into today, but that's a bad thing for your overall credit, your ability to go out and get new loans in the future. So, if I have anything to say about credit cards, if you get one, pay it off on time, and it'll cause you a lot it'll save you a lot of grief. So let's see, and there's a due date on the credit cards to be paid back every month. So say you get a credit card, $1,000 credit limit. the month of April, and you go out and buy $200 of clothes, $500 of food, so you have $700 that you spend on your credit card. Well, the following at the end of May, you don't pay back that $700, then you'll have to charge interest. And credit cards are very high interest rates. So even on $700, it's like 15 to 20% interest will be charged. So very high cost. But you also risk there's also a risk that you spend more than you have, because when you have that credit card, that is not money in your bank account. That's money that the bank is giving you to borrow. So say you only have $500 in your bank account cash, and you go out and you spend your maximum limit. Well, how are you going to pay that back in the future? So it's a risk that you can that's very high, but it's very prevalent, in our society. It can lead to a lot of financial problems for people. But there are good things about credit cards. If you are very diligent about paying them back every month, there are things called rewards. So credit card companies will give you rewards, say, every time you make a purchase. Say you go out and buy a $10 meal. Well, if you have a 3% cash back reward, you will get 30 cents. Yeah, you'll get 30 cents back on that. So you'll really, and that'll add up over time. So it can be a really good way to save, to build your credit. But there's a lot of risks to it. So pay it off on time, it can really be a big plus. So are there any questions on credit? Do we want to, while it's not over? If not, we can go to the Tia, talk through budgeting.
Okay, can you guys hear me?
Yep.
Okay, so since I'm not in the room, my name's Tia Newlove. I'm in Portland, so I appreciate you guys letting me join via Zoom, and I'll probably lean a little bit on Stefan and Connor since I don't think I'll be able to hear everybody in the room. But I'll be kind of talking about budgeting and taxes, and I'll try to make it as interesting and painless as possible. Could we go to the next slide? Okay, so what is a budget? So a budget is just, a plan for how much you're going to earn and how much you're going to spend. So if you think about it, if you have a job every month or every 2 weeks, you're getting a paycheck, and maybe you're spending that on food, on gas, on doing things with friends and family. And a budget is just planning that out in advance and then tracking how well you did against it. So I have, some questions for the group. I'd love to hear your guys' thoughts. I put them on the page, so I'll throw them out all at once and just kind of wait for you guys. So should you have a budget right now? When do you think you would maybe want to have a budget if it's not right now? And if you did have one, how do you think you would go about making one? So kind of a pretty broad question, but I'd love to hear people's thoughts.
And just sit here.
I'll start calling on people. What about you? Answering one of the questions. What do you think? You think you should? Why? Yeah, it's a great point. Nice.
Stefan, I couldn't hear. Could you just kind of summarize it for me?
Yeah, I said that if you, let's see if I can do this. If you don't have a budget, you could get to the limit on the amount of money you have. And if you go over that, you'd have to pay it back, or you wouldn't be able to spend over what your limit is.
Yeah. It's a really good point. Anybody else have thoughts?
Okay.
Let's go with you here in the middle. When you're older, yeah, that's a good point. She said when you're older.
Yeah. So could you flip to the next slide, Stefan?
Yeah.
Yeah, so the way I think of it is there's benefits to having a budget, but there's also a cost to it, or pros and cons. So some of the benefits I like to think about is like the ability to plan your money when you have a budget. And that doesn't just mean, planning for the unfun stuff like groceries or maybe a car payment. You can also plan for fun things, like maybe you would be really excited to go to like a concert or a game and you want to set aside some money every month to save up for that. I think a budget can be also, it can be strategic, but you can also think about like, how do I plan for the fun things I want to do? Another thing that I think is a real benefit is money can be like a really big source of stress or anxiety. I know it definitely has been for me in the past. And part of something that can relieve that anxiety is just taking the time to look at your money, to understand how you're spending it. I think, if you ignore it, then you'll constantly have like a little voice in the back of your head saying, I don't know how much money I spent last weekend or how much money I have in the bank to spend left. Like, what you said, someone in the room said it, you want to know how much money that you've spent so you know how much money you have left. So I think, really just taking a couple minutes to look at how much money you've spent can help relieve some of that anxiety. Some other benefits to having a budget is you can take the time to plan for the future. So like I said, if you want to go to a game, or maybe you're thinking about, saving money to go to school somewhere, or saving money for some kind of, fun purchase, or even a non-fun purchase. And I think another thing that's a benefit is keeping track of your disposable income. So when I say disposable income, I think about, every month, if you were to have to pay rent or have to pay a car payment or insurance, those are things that are pretty much a set amount you're going to have to pay, but there's, sometimes money that's left over that you can spend on, going out for dinner or doing things that are, let's say, extras or optional, and you can keep track of how you're spending that and, maybe what you want to save for in the future. But there's also costs to having a budget, and there's cons. It takes time to create it and track it. It's not always super easy. It's depending on how complicated finances are. And if you're not working a lot and you don't have a bunch of different sources of income, or you're not spending a lot, it might not bring you a lot of benefit to track. Like, so I did not have a budget in my first year or two of college because it didn't really make sense to me. I had a part-time job and I was spending some of that money on some things, but I think, when I was living on my own without roommates, it made a lot more sense to have a budget and try to figure out, how much money am I spending on, all sorts of different things. I think we can go on to the next page. Okay, so I just wanted to include some resources here. So there's a lot of different ways you could make and track a budget. I think probably the most common way these days are apps. So I did a screenshot. This is obviously old because it says it's from an iPod, of the Mint app. You could also, there's other budgeting apps that you can download and connect to a bank account or credit cards. You can make a budget in Excel, on a computer, on a piece of paper, if you just want to write it down. And something I think is a little bit old fashioned, but I still hear people doing it, is like the envelope method. So if you were a user of cash, you might say, I'm going to put $30 in an envelope, and that's how much money I get to spend on takeout or on something else. I can't think of any other examples. So there's a lot of different resources. I did include a link to, I think it's a Washington State University resource on like different ways you can create and track a budget that maybe don't take a lot of time. All right, are there any questions in the group?
Quiet.
I don't hear anything. So Stefan, could you go on to the next slide?
Yep.
Okay, so taxes. What are taxes except for, something that a lot of us complain about in the March and April timeframe? Next slide, please, Stefan. All right, so in the simplest form, I think taxes can be complex, but really they're a way that the government collects money to pay for things that the public needs. So things like fixing potholes in the roads, making roads better, paying for public education, so public schools. And then there's things like, that are generally considered a public good. So things like the Riverwalk in downtown Chattanooga, or providing money and resources to things like I think the Chattanooga Aquarium. So it's a way to collect money from the public to fill a public need. And there's a lot of different kinds of taxes, and they can be really complex. But I just thought I'd go over some pretty frequently asked questions as an accountant, and then we can do any questions that you all have too. So we can go to the next slide. Okay, so this will be my fast facts on taxes, and then we can go through any questions as well. So when you think about taxes, taxes are paid, by individuals, by you and me, but also by companies. So when we talked about corporate finance, most corporate finance groups have a tax function, and that's their job, is to calculate how much they owe in tax. I actually worked in our corporate tax group at UMUM for a while. And then you think about, who decides how much you pay in taxes, and that's a tax authority. And for the most part, you probably think about the IRS, which is the Internal Revenue Service. So that's the federal government setting, an individual and a corporation pays X percent in tax, but there's also tax at the state and local level. So, the state of Tennessee might have, actually don't think the state of Tennessee has income taxes, but the city of Chattanooga might have a tax that supports Chattanooga public schools or some other resource in Chattanooga. So probably haven't spent a lot of time thinking about how you pay your taxes or how you file them, but if you work for an employer, that employer will withhold taxes from your paycheck. So that reduces your take-home pay, but it sets aside that money so that when you get to the end of a reporting year and you need to do your taxes, so file your annual tax return, the employer, or if you're self-employed, you've made a quarterly payment, you've already kind of paid up. And so you're really just kind of truing up at the end. So you might owe a little bit, or you might even get a refund, but you will file your taxes based on an end of year calculation. And in general, most people have usually paid most of their taxes at that point. It's not like it's a huge amount of money that you're having to pay on, on April 15th every year, which is tax day. I will point out kind of one nuance here, which is, there's a tax return, which is what you're filing in the spring of the years. And that's, all your tax information. It shows how you calculated your taxes, where your deductions were. But a tax refund is different. So a refund is, if you file your return and you overpaid over the year, you actually get that money back because you overpaid the government, and they have been using that money for however long you overpaid it. So it's owed back to you. So that refund just means that you paid too much throughout the year. A little bit about, an accountant, when you need an accountant. So I like to think of it as, if you have a part-time job, or even just, your first job out of school, you probably don't need an accountant. Your taxes are probably pretty simple, and you could do them yourself. And that might be through an online service, like something like a TurboTax, which generally, but not always, can be free. Kind of depends on if you have to file a state return or if it's just a little bit more complex. There's also usually free resources within a community to help you prepare your taxes. So people will do volunteer tax return prep. So that's a great option as well. But if you have a bunch of different sources of income, maybe you have some complex investment gains and losses, which I think Stefan's going to talk about, then you probably want to have an accountant helping you with your taxes, making sure that you're doing them correctly, making sure that you're getting all the deductions that you can. And the best way to find an accountant is usually through the people that you trust. So through family or friends or people that you work with. And my last little note is that if you're using an accountant, they should generally have an active CPA license. There might be situations where they don't, but that's something you would always want to look for. So those are my fast facts on taxes. Hopefully that wasn't too painful, but are there any questions?
Yep, question?
Is there a particular date that the government has to pay your tax refund by, or is it just really like?
Did you hear that?
I didn't.
You said, is there a particular date that the government has to give you your tax refund by, or is it whenever they feel like it?
That's a good question. So it depends when you get your refund on when you file. So if you file your taxes early in February, I think the general like refund time frame is usually like less than 4 weeks. But right now the IRS is very understaffed, so it could be longer than that if it's taking longer to process returns. I would say in general, from the date that you file your taxes, about 4 weeks. But I don't think there's a requirement. I'm not sure about that.
Yeah, it's a good question.
Yeah. Any other questions? Okay, I'll give it to you, Stefan.
All right. Yeah, I'm going to talk a little bit about personal investing. So again, this is different than a company investing. This is when you have extra money. So Tia mentioned disposable income. That means after you pay your rent, after you pay your taxes, you have extra money. After you pay your credit card and your car loan, if you have one, you got to do something with your money. So what do you think you would do? Is it a good idea maybe to like go in your backyard and bury the money in the backyard? No? Definitely. Okay. So yeah, so the alternative to burying your money in your backyard is investing it. So there are a few types of investments, which they're on the screen here, but I'm just curious if you know what a stock is. Can you raise your hand? Okay. What about you in the back? You don't know what a stock is? That's all right. All right. And what about a bond? Raise your hand if you know what a bond is. Okay, some hand wiggles. All right. So stocks and bonds are like the major investments. So the major investment types. A stock is when you say to a company, I want to be a part owner of your company. So who knows what like Apple is? Do you know what Apple is? Raise your hand if you know what Apple is. Okay, who knows what Chick-fil-A is? I hope. Okay, so say, you went to Chick-fil-A or whatever and said, hey, Chick-fil-A, I actually want to buy a little bit of your company, just like a tiny little bit. And they said, okay, sure. Or maybe you want to buy a lot. They say, I want to buy 51% of your company. And then they say, okay, great. Now you get to make the decisions because you own the majority of the company. So that's what a stock is on a high level. A bond is like debt, but instead of you getting money and then paying interest, it's a company getting money from you and them paying you interest, which sounds better because you're getting money, right? And so a few things about the differences between stocks and bonds. So stocks, their returns are unlimited. They could literally go up forever, right? Which sounds pretty good. Like you could say, here's Chick-fil-A, here's $5. And then Chick-fil-A grows to the biggest company in the world. And now your $5 is worth a lot more, right? Unlimited, right? For bonds, you decide before how much you're going to get, which is the interest. So a company says, if you give us money, we'll give you 6% of that money every year for 30 years. And then we'll pay you back the original amount that you spent. And you might say, well, the unlimited return sounds a lot better, right? Like, who wouldn't want unlimited returns versus not unlimited returns? The difference is, can anybody just guess the difference between the two? Like, what is different about stocks and bonds? Why wouldn't you just always do stocks? Yep, stocks have the chance to go back down. That's exactly right. The reason why is because when you buy a stock, if a company fails, so say Chick-fil-A tomorrow actually goes bankrupt, which God forbid, right? But if they did, then they wouldn't have to pay you anything back. So you gave them $5 to become part of their owner, but now that you fail with them. But a bond, they have a legal obligation to pay you back first if they fail. So say Chick-fil-A goes bankrupt and then tomorrow they're like, well, what do we do? Well, we have all these chicken making machines, fried chicken making machines. We can sell those for cash and then we can give them to the bondholders because they get the first priority of cash. So it's less risky, right? So it's a give and it's a take. And then I want to talk about one more thing, which is the time value of money and compounding returns. It's a really complex topic. So if you can come away with this understanding a little bit more, then you're probably in like the top, like 5% of people in the world. Okay, so it's a tall ask, but we'll see what we can do. So like I said, you can either bury your money in the backyard or you can go invest it and earn a return. So because it can be invested, typically what we say in finance and investing is $1 today is worth more than $1 in the future. What that means is if you give me $1 today, I'll go invest it and earn some return in Chick-fil-A, and it'll be worth more in a year from now than getting $1 a year from now that wasn't invested. Does that make sense? Okay. But the very cool thing about investing money is if it goes up, so say you invested in Chick-fil-A for $5 and in a year it's worth $6. Now you have $6 to invest, not 5. So you can earn money on your money every year. And that's like compounding, right? So the example here is like a stock example. So if you see over on the top right, so today you invest $1. And 1 year from now, the stock goes up 10%. So what's 10% of $1? 10 cents, right? And then you invest that 10 cents in Apple. And so you have $1.10 invested in Apple. And then a year from then, so 2 years from now, it goes up another 10%. But instead of just earning 10 cents, you earn 21 cents. The reason is because you earn 10% on the 10 cents that you got. So it's compounding. Does that sort of make sense? Yeah, question. You do? What do you have invested? Okay, we'll get to that. And bond, just to really kind of round it off, is the Conor gave the example, which is basically you give money now, the company pays you interest, and at the end, they'll give you back your money, and you've made all that interest, right? All right, so there's really kind of 2 different types of personal investing. One is for retirement. Does everybody know what retiring means? Raise your hand if you know what that means. Okay, I was like, I can't wait. Retiring means you eventually have the benefit of stopping work, right? You've worked your entire life and then you say, you know what, now I just want to like enjoy my life. And so to do that, you have to save money, but you also want to invest the money so you can have the most money possible by the time that you're retirement. And then there's investing for fun, which is, you know, I mean, maybe you're investing for retirement, but more than likely, you know, you're investing for fun. And so when you think about investing for retirement, and then you think about investing for fun, you really should think about those things in two different ways. Investing for retirement is really like long-term, right? So typically people retire when they're 65. And I think y'all are kind of like far away from being 65, right? So that means like long-term. Investing for fun is like short-term. Like you see a cryptocurrency that you like and you say, yeah, I'm gonna invest in this. Maybe it'll go up, maybe it'll go down. But more than likely I'll know after a year and get my money and invest in something else, right? Investing for retirement, there's also two ways to do that. One is to hire a financial planner. And that's like someone in a suit that'll tell you, hey, you know, you have these goals, and to get these goals, this is what you have to invest in and things like that. But then there's also passive investing, which is really just saying, I'm gonna go out and buy a bunch of stocks and a bunch of bonds and just let it sit for a long time. So it's less active. Investing for fun is really like when you open an investment account. So if you raise your hand if you've heard of like Robinhood, not the cartoon, but the app. Okay, so Robinhood is like a fun app where anybody can get on it, put money in it, and invest. And really the point or the difference between the two is investing for retirement requires a lot of patience because you have to wait until you're 65 to take the money. And you have to trust that over time, that compounding return thing will mean you have a lot more money if you just wait. And it's also where you shouldn't risk, right? Because you don't want to risk your financial future, right? And so the difference between that and investing for fun is you're taking small amounts of money and doing whatever you want with it. Like if you want to buy crypto, if you want to, I don't know, do whatever you want, buy an NFT, you can do that. And so that's the primary takeaway I want you to understand for this slide, is that investing for retirement is long-term, requires a lot of patience, and investing for fun, you know, you can throw all that out the window, right? So who would rather invest for fun? Raise your hand. Okay. This guy's a long-term thinker. You'd rather invest for retirement? Okay, nice. All right, so the last question I ask is should you invest? And the answer is absolutely. If you have it in your budget, you should do it, but you have to think about it in one of these two ways. Is this for fun? And am I okay losing this money if I risk it? Or is this for my future, right? And this is just an example of, and I want, if you take away one thing from this, it's that it's very, very good to invest long-term. That means put your money in something, in a stock, or lots of stocks preferably, and then leave it for years and years and years and never look at it, because when it goes down, you'll be like, oh man, I should really take my money out. But the answer is no, don't take your money out, leave it, let it stay. And the reason for that is these two graphs, this is the S&P 500. The S&P 500 is the 500 biggest stocks in the US today. And this is the S&P 500 over the last 6 months. So you see it goes up and down and up and down and up and down, right? So maybe you are here and you're like, man, I'm feeling pretty good. I invested here and my money went up. and now you're here, and you're like, well, the money went down, so I'm gonna sell it. Don't do that, because then you're losing out on this. If this is the S&P 500, the same thing, since, let's see, 1982. So since 1982, which was at $118, it's gone all the way up to 4,436. So the point is, there will always be ups and downs in investing, but you should think about the long term, because your money will grow to a lot if you're patient, right? And that kind of gets us to some investing for fun and investing for lack of patience, or what I like to call gambling. So who's heard of GameStop before? Raise your hand. GameStop, okay. It's kind of like a cultural phenomenon right now. And it's wild, because when I was like a kid, which was like 10 or so years ago, like I didn't even go to GameStop. Like I was like, you know, ordered my games online. But anyway, GameStop and there's this culture of like everybody on the internet finding a stock they really like and investing in it. And it's typically a really risky stock. So GameStop is an example where, I don't know if anybody knows what Reddit is, but people on Reddit will invest their entire financial future in GameStop. Hundreds of thousands or even millions of dollars invested in GameStop. And what this is here is diamond hands, which what it means is like, don't ever sell, which is a good thing, you'd think, but not if you're talking about GameStop. Because GameStop is incredibly risky. And that's really the point that I'm trying to make here is things like cryptocurrency, things like GameStop, things like NFTs. How many of y'all know what an NFT is? Okay, we won't talk about NFTs. It's incredibly risky, right? GameStop was worth $10 a share or something like that. It was almost bankrupt, this close to bankruptcy. And you remember we learned that if you have a stock and it goes bankrupt, you don't get your money back, right? And then suddenly it goes up from $10 a share to $400 a share. Based on what? Based on people buying it. That's it, right? So that means it's really risky. It could go down at any point when everybody says, you know what? This whole GameStop thing, what was that about again? And then they're like, well, I guess I'll sell it. And then it crashes, right? And you don't want to base your financial future on something like that. Cryptocurrency is an interesting one too. There are cryptocurrencies like Bitcoin. Who's heard of Bitcoin? Bitcoin is like a lot more famous of a cryptocurrency now. And so it's actually safer because it's more famous. Because everybody agree that it's, you know, something that can be traded. It's a little bit safer. That means if Bitcoin goes up 10% and then down 10%, think of another cryptocurrency that you've never heard of. Maybe you've heard of Dogecoin, maybe you haven't. Dogecoin will go up 50%, but then down 50%. So it's a lot more volatile than like a Bitcoin. And so really though, the point is when you're thinking about, and you'll be confronted with this in your life, these people that really want to take a lot of risk to try to get a lot of money really quickly, and they end up losing it, right? It's 50-50. Maybe you make it, maybe you don't. It's really gambling. The point being, if you do this kind of investing, you should do it for fun, like the fun type of investing. But if you do, you know, investing for retirement, then you should stay away from these things unless they're very, very small portion of the money that you have overall. So that's really it. Are there questions about personal investing? No questions? You guys are so clear. Tell me about your portfolio. What cryptocurrency do you have? Dogecoin. Nice. I invested in Dogecoin. But when my wife, and this is an example, my wife was like, hey, should you invest in this Dogecoin thing? I said, I'll do it, but I'll only invest a very small amount. I invested $100, which may sound like a lot to you guys, but to an adult, that's like, yeah, you could lose $100 and it'd be okay. And luckily it went up, but there was an equal chance that it went down. So I didn't risk my financial future for Dogecoin. So that's really kind of the point. No, because I said, if I'm going to invest in Dogecoin, I'm going to invest long term. So I still have it. But it made a good return. Diamond hands, yeah, that's right. But anyway, any questions? Is that a question? That's a really good question. Tia, she said, if that's considered gambling, why can you be younger than 18 to do it?
Because it's not well regulated because it's so new.
There's no regulations around it.
That's right. So right now, and this is probably more than you need to know, but the SEC, which is the Securities and Exchange Committee, they make sure all of the investors like you are being taken care of. They're looking at this stuff like crypto and meme stocks and NFTs, and they're like, what do we do? Because it is blowing up and they're trying to regulate it as fast as they possibly can, but it's not regulated, right? Like the risks are really high, and some things like Robinhood looks at cryptocurrencies and they say, that one is too risky. We're not going to put it on our platform. We don't want, a 16-year-old coming in here and buying a cryptocurrency that could be a scam, for example, and lose all their money. And so Robinhood, who is kind of taking on some sort of their own regulation, is doing it themselves. But the SEC is scrambling to try to get rules like that in place to try to regulate. So it's a good question, but yeah.
How many different, like you mentioned a few names of different, is there,
Stocks or cryptos?
yes, how many, are there thousands, are there just hundreds?
Yeah, so if you look at like, say, 10 years ago, there was probably like 3. It was Bitcoin, it was Ethereum, is that what it's called? Ethereum and Litecoin. So that was like the major 3. Now there's literally thousands. And there's been examples where people will create cryptocurrencies that are actually a scam, like they have no intent to continue with the crypto building. And so people will buy all the crypto that they see for this new cryptocurrency. And then the people that made it are like, yeah, this is actually isn't real. And then it'll just go to zero, right? And it's legal because there's no SEC safety around it that we need. So good question. It is scary. That's the thing. Is it? It's a good question. So it's not tangible. So that's what. And really, I think you're asking the right question, because in the US, the way that we created money was through gold. So we said, well, which we don't do this now, but say if you have $1, you know that you have physical gold backing it. Now we've kind of come away from that now, as we don't have necessarily gold backing every dollar, but what we do have is the full faith and credit of the United States government, who says, if you have $1, it's worth $1, which is important. The difference between crypto is the only reason it's worth something is because whoever buys it says that it's worth something. right? So if 1,000 people say, yeah, we'll pay $10 for Bitcoin, then Bitcoin is worth $10. So that's why it's volatile though, because it's completely based on what people decide it's worth. So
And that's a big difference between buying the stock of a company versus buying Bitcoin, is that the stock of the company comes with cash generated by that company, then they pay you. So like in things like dividends that you have when you own a stock, or just the capital appreciation of the actual price of the stock. So
yeah,
you have a bit, when you buy stock, you have a business behind it creating more money. And then when you have Bitcoin, it's just like people, it's how people perceive it. If people tomorrow perceive it not to have any value, they'll take it.
Yeah.
There's nothing behind it creating more value.
yep.
So is there a set number of stocks?
That's a really good question. And yes, there is. So companies will, when they decide to go public meaning you can buy them on a stock exchange versus a private company. So Chick-fil-A is actually a really big private company. You can't actually buy Chick-fil-A stock, but you can buy Apple stock because they're a public company. So when they go public, they issue a number of shares, and they go to the SEC, that regulation committee, and say, we want to issue this many shares, and they're all worth par, which I won't get into, but it's a set number. And if they want to issue more shares, they have to go back to the regulator to issue those shares. But typically companies don't do that. So there are a set number, but it depends on the company on how many they want to issue.
How many shares do you have? I want to guess because I should know this.
It's like 350 million shares, I think UMUM has.
Yeah, because it's $7 billion.
So good question.
You guys mentioned financial planner. And I always assumed or heard, I don't believe, that you should have a really large portfolio. Super need one or desire one. But when would you recommend looking into getting one, looking at maybe budgeting with one?
Yeah, good question. So these are my opinions. But my opinion is that you should only go to a financial planner when you have a complex enough financial situation that you need one. So for example, having potentially multiple companies, like you've got real estate, for example, you've got a large investment portfolio, you've got a complex situation where you need, for example, like estate planning and things like that. Because from my perspective, one of the best ways that you can invest is by going to the S&P. So say you're young, go to the S&P and just buy the S&P. And then as you get older, add in some bonds there. And so an easy rule is like, if you're, and I forget the specific rule, but it's like, if you are 20 years old, you should be buying 100% stocks. But if you are 80 years old, you should only have 20% stocks and like 80% bonds. So it should grow over time. Most financial portfolios are going to be great just investing in a general portfolio like that. And more than likely, that's what a financial advisor is going to do anyway. What a financial advisor brings benefit of is if you have a complex situation that you're like, I just can't do this on my own. Or if you have estate planning, or if you need things like life insurance that you don't otherwise get at, your company. That's not to say that planning with a financial planner, if you don't have a complex situation, isn't good. But I think there's a lot less benefit in it because you can do a lot of it yourself.
I'll add, just like Stefan, definitely on point with that. There's a lot of resources that come along with retirement, like investing for retirement platforms. So things like a Fidelity Investments, like those accounts typically will offer you free information about what they think the breakout of your portfolio should be based on your age, when you think you're going to retire, how much money you think you'll need at retirement. And they'll kind of do that calculation of you should have 80% bonds, 20% stocks, or your mix of stocks should be this risky. So I would agree, like unless you're in a pretty complex situation, there's a lot of resources that wouldn't require you to use or pay a financial advisor.
Yeah.
Because if you go out and buy the S&P 500 index fund, the expense ratio on that is so low, it's very cheap to own that. But if you go and have a financial advisor, for instance, it's, you know, it can be upwards of 1 to 2% in our portfolio per year. So yeah, there's a big cost there.
Yeah. Good question.
So, so you said there is a set number of stock, but the price stock is go up when all the stocks are up?
Yeah, good question. So that's exactly what causes the stock to go up and down, is after they issue a set number of shares, and then say someone is, you know, so say they issue the shares, a lot of people buy them, and then people want to buy and buy and buy the stock more and more and more. That's going to push up the price, because just like, you know, anything that you can think about that anybody wants more is going to have a higher value, right? So like think of like a baseball card, or I don't know if you still do that, like a Pokemon card or something. No? Okay. Like let's say it's like do you play Fortnite? Gosh, okay. Well, say
Here's the Tom Brady football that wasn't his last throwing touchdown, but what they thought it was his last touchdown ball sold for $500,000.
yeah,
Right? Because there's a supply and demand, and only one of those person that wanted to pay $500,000 for it because they thought that was their market value. Stocks are the same basis as a trading number. If there's not any in circulation, somebody will pay more than market value to get it. So
Yeah.
in real life terms, the stocks and bonds, Elon Musk just paid $44 billion for Twitter, and they paid 28% higher than the open market for the stock of what Twitter was to make that transaction happen. That board of directors essentially have to make the deal because there was really no way out of it to do that valuation.
Yep. Good question. Yeah, really good. Thoughtful question, thoughtful group. Well, cool. Well, thanks everybody for the time. Thank you, Tia. And yeah, really good. So, thanks for letting us.
Thank you all so much. That was very